If you want to know where you're going, you need to know where you're coming from. Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk. Dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast, where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Gold investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast mini-series. Market review today. What's coming up next? Vero, are you ready for this?
Well, today is all about knowing where we came from to understand better what's next. You pretty much said it in the introduction. The least to say is that the stock market surprised us again in 2025, up double digits for the third year in a row.
Yeah, and I cannot help myself to stop thinking about one of our member at DSR back in, I don't know, February or March. And he said, "Oh, I'm going to wait on the sideline until the tariff news are all up and that we know where we're going." And at first, on Liberation Day in April, the market dropped like crazy for about like a week or two. So down about 10%, very, very fast. And then boom, V recovery, not even after a bear market. It was just like going down a little bit and then going up. And if you have been sitting on the sideline in 2025, you're probably regretting a little bit right now. And now you're probably thinking, oh, I'm going to wait a little bit longer, because the last time we had 3 years with double-digit returns back to back to back, well, it was in the late 90s, and I can't remember how the story ended yet. So anyways, be prepared, if I could put it that way.
So one of the big surprises this year is seeing the Canadian market outperform the US market despite like the Magnificent Seven on the US side. How would you explain this?
That's incredible, right? You would have thought that AI would have driven the entire market, and then the market has like barely nothing in the technology sector, so definitely not the place you want to invest. And then boom, we have like a very strong performance from financial banks and the Canadian banks, sorry, and life insurance companies. Most of it actually was driven by the stock market. So they reported great earnings, market got on fire for that. And then we have the debasement trade that we're going to talk later on in this series. There is a big rush into gold. So the most gold mining stocks are up like more than 100% in 2025. That was just crazy. And finally, a little bit of AI, because I mean, we don't have tech stocks, but we do have something else. Well, if you have more people using AI, more companies using the same thing, then you need more cloud services, you need more computing power. That leads to more data centers, which leads to more power. So utilities are on the roll, and industrials to build those data centers are also on the roll. So that explained pretty much what drove the market on the Canadian side in 2020.
Okay, but what happened in the financial sector? Like, are banks that good? Like, what's going on?
I mean, they're amazing, right? But I mean, but here's the thing, and there's a catch actually. So for the big six, the common theme was capital markets and wealth management, double digit, and sometimes up like 30-40%, like crazy numbers. So to understand what it means, well, capital markets is all the money that is invested in the stock market. And then wealth is, of course, charging fees on assets under management. So all the financial planners, the brokers, the private banking, but they all benefited from the market being up for a third year in a row. So naturally, if you don't lose client and you don't gain client, your asset under management keeps going up anyway, because the market is positive. So the fees you're charging are just increasing, but you're doing the same job. So you technically keep about the same margin or better, and then you're just charging more money. So that what propelled Canadian banks and life goes as well. So life insurance companies, they invest a lot of money in the market. They also have their wealth management because they do retirement planning and such. So They have similar services. They benefited from that as well. But the things that we don't talk enough about is the fact that banks raise their provision for credit losses across the year. So
Mm,
the classic banking activities is not doing that well. Yes, Canadians are getting more and more loans. So you're just like, hey, our loan portfolio increases. So we're making more money on our interest charges. But here's the thing, if Canadians keep on getting into debt at one point, sooner or later, they will have to pay that off. And now we have
right.
PCLs that are increasing. So it's kind of like a problem hitting on plain sight because all the other business segments are doing so well that nobody cares about banking activities. So they're doing okay. They're not catastrophic right now, but I'm just a bit worried about what's going to come up next.
And it does say a bit about the economy in general, right?
Definitely. I mean, if you look at like Equitable Bank, EQ Bank, and Go Easy, they did not have the same results on the stock market, but they do not have this exposure to wealth management and capital markets. They focus on lending, mortgages, and stuff like that.
Okay, so let's go back to AI for a while. Like the AI bubble, so to speak, creates as many opportunities as it creates red flags. How can investors differentiate the two?
Oh my God, that is so not easy. The thing is, we have a lot of great companies that are trading at higher multiples, mostly because they are surfing this tailwind. So, the way I approach this in 25, and this is how I'm going to continue to do that in 26, is to identify companies that were doing well before this tailwind. So, companies that had other growth vectors than just AI. So then, yes, they can benefit from investment in it, from using it, but they still have other ways to grow their business. So instead of like going for a company that just got almost saved by the fact that they are linked to AI, like either building data centers, providing chips or networks capacities. So I don't want to have a crazy exposure on it as well. So I always talk about like that sector allocation. Then you have to be a little bit more cautious when you look at your portfolio because it's not just the tech sector. If you have like 20% in the tech sector and they're all semiconductors, and then you have like Alphabet and Meta in your portfolio, they will fall in the communication sector, but really one of their main growth driver is still AI. And then you have
Right.
utilities and some energy stocks that are doing incredibly well because they're providing the energy to power those data centers. So it's all related. So now AI is not just about tech stocks, it's a macro play on the economy.
And with all that in mind, Mike, what's next for 2026?
Well, what we're going to talk about in the webinar in a deeper dive on that is I don't think we are in a bubble yet. I think that there's still a lot of room to grow around artificial intelligence and we have like good comparables that we can do when we look at the dot-com bubble and everything that has been done there. But we're going to talk about it in the webinar because we cannot go on and on and on in this mini series. It's the point of having a mini series, right?
So, Mike, like you just mentioned, we will host a free public webinar on January 8th. The presentation will be a deeper dive into what happened in 2025 and what's next. You will also share stock ideas for the year. So, what's the best reason not to miss
So it's obviously packed with a lot of information, but my goal is not to just throw intel at you. I want to give you actionable intel. So the difference is instead of being entertaining, you're going to know what's coming up and then how you can position your portfolio if you want to take action. So instead of just like spreading a bunch of facts, we're going to talk about strategy and we're going to talk about how you can do a better job managing your portfolio in 2026.
All right, so I think it's clear now that you should not miss this, listeners. Save your spot at thedividendguyblog.com/webinar for the live session or to get the instant replay if you cannot join us live. I will join you in the chat to tag your questions because, I mean, we always take some time for that, at least an hour. Thank you, Mike, for highlighting the most important facts about 2025. For our show notes and the complete series, visit thedividendguyblog.com/260 one. Do not miss an episode again. Hit pause and the subscribe button underneath our logo to get notified. And until tomorrow, stay invested.
Stay invested. Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk, dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time.